Good afternoon, everyone. Welcome. Thank you for signing up to learn about tax strategies and ways to minimize your taxes today and for the long term. We're really excited about today's presentation and believe everyone will come away with some new ideas. I'm LaLomia from Turning Point Financial. Little housekeeping before we get started. I like to be upfront and tell everyone what's going to happen here today, so we have no surprises. There's three basic parts to this presentation. First, we'll take you through various tax strategies and potential ways to lower taxes. Second, we'll show how this might personally affect you. There's many factors that must be considered. Lastly, we have Q&A. Please use the chat box at any time with your questions, and we'll answer those at the end. We want to help you understand that there are actions you can take today that can have an impact on your life and lifestyle in the future. We have everyone muted, and while my video's on, yours does not need to be. Two things that are not happening today. We're not here to sell you anything. And second, we can't provide personal financial advice in a group setting like this one. That has to be a one-on-one activity. What you're about to hear, that represents the best and brightest thinking from our team and is the collective wisdom of over 100 years experience. Taxes are not a fun-filled topic, and we'll do our best to keep you engaged with some real-life stories of families that we've worked with. Turning Point Financial is a fully registered investment advisory firm. We're supervised by the SEC. Our home office is in Frederick, Maryland, and we work with federal employees and clients from most agencies across the entire country. Here's a nice picture of the team. We're fiduciaries, which means we put your best interests first. We get asked this a lot because it's important. If you're looking for an advisor, this is a good question to ask. Not every financial advisor out there is a fiduciary and is held to that standard. One more thing, you can learn more about my firm on our website, tpfinancial.com. So let's get into it. Long-term tax planning. What happens if we don't have a long-term tax strategy? Well, the obvious answer is you're going to pay more taxes over the long term. Perhaps not this year or next, but it's likely it'll cost you a lot more over the long term. And there are little things you can do today, this year, and beyond to lower your long-term tax bill. Participating in a Roth is just one example, and I'll show you some ways and share some stories. Think outside the box for a sec, and not just what your family earns in a year and the taxes owed in a year. Think about the total of all those taxes paid during your entire working career. It's scary because it's hundreds of thousands of dollars and probably more. What if you could chip away at that? Put some dents in that and lower that big tax bill by $50, $100, $200,000 and have that for some fun money in retirement. Getting advice from a financial planner or tax advisor can and does save the kinds of money I refer to. I see it all the time. But for it to work and to maximize the impact, it needs to be done well ahead of retirement. You simply cannot start on this sort of thing too early. For most people, if you do nothing and simply keep doing what you're doing today, you'll end up with what we call the government plan, which is paying taxes for the rest of your life at whatever rates they tell you. You have a choice. You can make your own plan by acting today and actually creating tax-free sources of income. A Roth is one of the ways to do this. That can be Roth TSP, Roth 401k, or Roth IRA, to name a few. The choice is yours. You can take their plan and adapt to tax laws as they change, or you can make your own plan. If you're making your own plan, I suggest working with someone who knows what they're doing. Long-term tax planning, it involves understanding all your sources of income during retirement. You may have a pension. We'll all have Social Security. RMDs, which are required minimum distributions. The Roth we talked about. Some folks plan to work in retirement. They'll have part-time income. Some folks have rental properties, rental income. Your spouse or partner, what do they have going on? A portion of each of these is taxable, and the impact it has is something you need to know. It can be complicated. We all agree it's okay to pay our fair share of taxes, but no one wants to leave the IRS a tip. Creating a financial plan early on and getting in front of the tax obligation, that's one way to make your own plan. Roths, they remove the uncertainty of future tax rates. Moving along, take a look at all this stuff. This is why it's so complicated. Just look at what we have here on this slide. What is all this stuff? Sure, some of it looks familiar. Folks, we're not going to go through all these and get into it because it would make your head spin. Yes, some of it's important. Estate tax thresholds, those changed with the last administration. And those numbers are set to expire in 2025. I have a good story for you related to the gift tax there at the bottom. $15,000 is the current law. You're allowed to give an individual up to $15,000 without any tax consequences. My colleague, John, his daughter is getting married later this year. And John and his wife have decided to help out with wedding expenses. Pretty common. John has some stock, and John wants to use that stock to pay for the wedding expenses. Well, if John were to sell that stock, he has to pay capital gains tax on the gain. There's a tax consequence to it. But what John came up with, the cool little strategy that John came up with, he's going to gift that stock to his daughter. His daughter will sell the stock, and there's no tax consequences. There's no tax consequences because his daughter is in a different tax bracket. And that tax bracket today has no capital gains tax. Thought you'd enjoy that. Not too many people know that. Not too many people do that. Good for John and his wife. Moving along. Got some good stuff on this slide here. Long-term tax planning. One of the things you want to do is put things on autopilot. Have money come out of your paycheck each pay period automatically, and allocate that money to your 401k, your 403b, TSP, FSA, HSA, that's health savings account and flexible savings account. Doing these things, that can lower your current taxable income. The health savings account, or HSA, if you have one of those, build that up. Use that in retirement to pay for a variety of medical expenses. Think of it as a Roth IRA for medical expenses, only it's triple tax-free. The Roth is only double tax-free. It's a no-brainer. Money goes in pre-tax, it grows tax-free, it comes out tax-free as long as you're using it for medical expenses. And it gets even better. You can invest the money. So if you're young, an HSA is probably the absolute best thing you can do. Different types of accounts offer different strategies. And this goes along with what I touched on earlier, tax-efficient withdrawals. If you have options to take money from accounts that offer different tax rates, you're truly in your own plan and not the government plan. And that's where we should all strive to be. The types of accounts that I'm referring to are Roths, traditional IRAs, investment accounts, 529s, HSAs, FSAs, and bank accounts. I've been a do-it-yourselfer off and on over the years, so I get it. Since we started our tax department nearly 2 years ago here at Turning Point, I'm continually amazed at how our CPA constantly finds mistakes in tax returns. And not just from do-it-yourselfers, but from professional tax preparers. They're making mistakes. TurboTax, in my opinion, or any other software, that can be manipulated. It works with what you tell it. And it's not proactive. It cannot do the type of tax planning we're talking about here. I'm not trying to sell you on our tax services, but just open your eyes to things we encounter all the time. Working with someone you can trust, someone who proactively gives you advice, that's where we all should be. When we're doing financial planning for our clients, I'm constantly pushing for ideas and recommendations from our tax department to improve a family's financial situation and address that massive long-term tax bill. Hang with me on this a sec. If an individual makes $100,000 a year and pays $25,000 in a year in taxes, over a 30-year career, that's $750,000 in taxes. What if we could reduce that to $650,000 or $600,000? That's serious money saved that could be invested along the way to provide for an early retirement or certainly more comfortable retirement. Audits, red flags, I'm not going to say too much about those. Everyone should know that the IRS never calls. It notifies by mail. I'd say get help if you don't understand what's going on with your audit. And red flags, I mean, they're unique to each family. Just look at this. Missing out on these sorts of things goes back to what I said before. I'm okay paying my fair share, but I don't want to leave the IRS a tip. Missing out on deductions on this slide, that's leaving the IRS a tip. Number one, that's big, and that's pretty common. And this applies to folks that own mutual funds or stocks and have their dividends reinvested. When they sell and they forget to add back in all the dividends they received over the years to the cost basis, it ends up becoming a double tax. You already paid the taxes on the dividends when they were distributed, but you haven't lowered your cost basis by adding those back in. Big mistake, common mistake. Number two, if you do charity work, there's a mileage allowance for driving to and from where you perform your service. The fourth one there, I'm going to add to that. Medical receipts. They're also a possible deduction. If you have high medical expenses and those exceed 7.5% of your adjusted gross income, that could be deductible. Keep your medical receipts. Another story for you. One of our clients was making a major mistake, rather mistakes in their tax life, despite having their taxes done by someone else. As I said before, mistakes are common, and unsolicited advice from CPAs or tax preparers is uncommon. Always ask your tax preparer for ideas and suggestions. Many are not forthcoming. Some examples of what we uncovered with our client: they were not taking advantage of deductions for medical expenses, including mileage. The client has 3 kids and they're doing well saving for college, but they're missing out on their state's generous state tax deduction. It's through a 529 plan. It's New York State, which provides a $10,000 tax benefit with its college savings programs. The client, they had a Roth, but they weren't utilizing it fully. We suggested setting up another one for their spouse and making annual contributions. Family also had someone considered special needs, and it didn't have an ABLE account, thereby missing out on those tax benefits. Lastly, the long-term tax strategy that we recommended, which included some Roth conversions, that will save this client several $100,000 in our estimation over their lifetime taxes. I point all this out because I believe each of us needs to take a very close look at our personal circumstances as we begin to file in the coming weeks. The question to ask is, am I overpaying the IRS? Hang with me, folks. I know this is a lot. It's definitely worthwhile. We're moving on to the Roth next. A Roth, that's one way to incorporate a strategy to manage the uncertainty of what future taxes might look like. Everyone on the call today should have some of their retirement plan invested in its Roth portion, if you have that option. If not, you might consider a Roth IRA. And by the way, everyone can participate regardless of your income. If you believe or you've been told you make too much to have a Roth IRA, you are misinformed. A little used strategy called a backdoor Roth allows high wage earners to have Roth IRAs. Let me know if you'd like to know more about it. I just want to pause for a sec, make sure everyone is understanding this. What we're suggesting is a Roth IRA, which you would do on your own or with someone like me, or Roth participation through your employer's retirement plan if they offer that option. Some people do both. The Roth is funded with money that's already taxed, and it grows completely tax-free. It then comes out tax-free. When you need money in the future, you can use the Roth without having to pay extra taxes. Think about it. If the tax rate is higher in the future, you'll be in a great position to have access to tax-free money. That's the Roth. Anyone with a 401k, 403b, TSP, you need a tax solution. And taking advantage of today's tax rates on sale is the way to be thinking about Roths. Roth conversions, that's something I do every year as part of my long-term tax strategy because it allows me to lock in today's low tax rates. You're paying taxes once and never again. Having a Roth removes the uncertainty of future tax rates. Best of all, they're invisible on your tax return in retirement. The Roth conversion, it's simply converting or moving money from a traditional IRA to a Roth IRA and paying taxes on the converted amount. Those taxes are paid when you file. If you or your spouse have old 401ks, 403bs, or IRAs, you can use them to jumpstart a Roth. Just to repeat, it involves paying taxes now in exchange for not having to pay tax on distributions later, like during retirement. What do you estimate the future tax on your RMDs if you do not convert? I convert a small amount each year because the tax bill on converting the entire thing would be too much. This is my plan, and I want my plan, not the government plan, which is RMDs. RMDs are required minimum distributions. Those start at age 72 for any traditional retirement plan. That's IRAs, 401ks, 403bs, the TSP. We call this the government plan because it forces you to take a certain amount out each year. This is how taxes are collected. Those RMDs are taxed. Roths, they don't have RMDs because we've already paid the taxes up front. You don't have to take the money out if you don't need it. Here's a crafty little strategy for folks that are already retired and taking RMDs. We use life insurance as a strategy to get tax-free money to our loved ones. If that's important to you, then using a life insurance policy is a great way to do it. Life insurance death benefits are tax-free to the beneficiaries. In our example, this person is obviously financially sound, has a little extra cash each month. We take that little extra cash and we're going to pay some life insurance premiums. If you're charitably inclined and you wanted to leave money to a favorite charity like your church, those premium payments, they could even be tax deductible. Obviously, this is not for everyone, but for folks who want to leave a legacy, it can be worth exploring. Financial planning. I work for a financial planning firm, so I'm admittedly biased. Here's some of the things that come up in the plans that we do for families. If you don't have a plan, you only have a wish and no roadmap to achieving that wish, dream, goal, whatever you'd like to call it. You may still get there, but it'll likely take a lot longer and be a lot more frustrating. A recent financial planning client we worked with, they have a dream of retiring early. And they've been good savers and investors their entire careers. But they had too many accounts. They didn't know how their investments were allocated. They were not taking advantage of college savings plans that offered tax benefits. They had too much money in savings accounts earning nothing. There was no Roth participation and no long-term tax strategy. With our advice, solid direction, and accountability, this client, he'll get to do everything he wants for his family. And he'll realize over $1 million in savings with the strategies we recommended. Had the client waited until he was on the cusp of retirement to have the financial plan done, the cost of waiting for him is well over $1 million. Obviously, not everyone can reap savings this large because each of our circumstances are unique, but savings of some sort is possible for everyone. You won't know if you're ready to retire without knowing what you'll need in this new phase of your life. It's never too early to start planning, and to do it right, you need to dig into the details. The process, it gives you clarity. You'll really know what to expect. Everything works together. What you make, what you spend, what you have, and what you need. Taxes are often ignored, but can make a huge difference to your bottom line, as we've shown. The biggest mistake we see people make, it's not asking for help when they really need it. Fortunately, you have resources. Several federal agencies, they've asked me to be a resource to you. You should contact me if you need help or have questions about anything we discussed today. Use my contact information here on the screen. Everything's completely confidential. You can also learn more about me and my firm on our website or connect with me on LinkedIn. Thank you all for being here. Please feel free to share this presentation. Be safe, stay healthy. Let us know if we can help. Have a great afternoon.